GM, good morning. Welcome to The Milk Road Show, the daily show that's as satisfying as a midnight snack. I'm your host, Jay Hamilton, and today we're talking about the likelihood of a US recession and how you should position your crypto investments to prepare. Here to guide us is Lark Davis, who researches crypto markets every day for his millions of fans. Lark, why do you think the potential of a US recession is such an important topic right now, particularly for crypto investors?
The reality is that if a big recession hits, particularly a big one, but any recession is probably enough to spook investors in the short term. But if a recession hits for US markets, it's not a question of if, it's just a question of when. Recessions are a normal part of the business cycle. But when that recession hits, sooner or later, right? Sooner is what everyone's worried about. You have to just keep it real with yourselves, okay? When we have bad economic conditions, when people are losing their homes, when people are losing their jobs, they're not buying dog coins. It's just a straight fact of reality. Unless they get giant stimulus checks from the government, then they're buying dog coins, and that's full on bull then. But outside of that, it's problematic because when people are struggling to put food on the table, investing in speculative assets is, and crypto's the most speculative assets, is the last thing on their list of things to do. Now, there's always going to be people with money. There's always going to be people in the markets. There's always going to be other countries that are doing well outside of the US. There's always going to be investors, right? You got to keep in mind the bottom half has zero investments and can't afford $1,000 emergency, right? But the people at the top tend to be doing a bit better, but still during a recession, the smart people are going to tighten their belts a little bit and try to let things blow over and ride out the storm. And that, again, doesn't speak well for your dog coins.
Okay, so let's start out by looking at the bad. There are several indicators. I believe we have five that we're going to look through today of what is signaling that we are going towards a recession right now.
Yeah, there's a lot of indicators we can look at. And the worrying part is things like the yield curve. It has such a strong track record of being right that it's worth paying attention to. Now, I do need to caveat that with any indicator, and I mean any indicator, can always have a false positive. Any indicator can be proven wrong at some point. Just because it's worked in the past doesn't mean it's definitively always going to work in the future. But when you have such a high hit rate, it's worth paying attention to. So maybe we start this conversation by talking about those unemployment numbers, because
Mhm.
this is what really spooked the market out last week. So there's two rules here in particular that we could talk about. They're both dealing with recession, with unemployment numbers and how that could impact a recession coming or be an early indicator for a recession coming. We have the Piper-Sandler rule, and we also have the SAM rule. So we don't need to go into the exact mechanics of both of them, but just to understand both of these indicators are flashing. And when they flash, generally it indicates that a recession will follow sometime in the near future. Now, that's not necessarily tomorrow. That could be 6 months down the line, maybe longer, but it's coming. It's coming. And this is part of what the Fed has done to the markets by their higher for longer. At the start of the interest rate hikes, you had Jerome Powell come out and saying, well, we got to put a bit of pain on the economy. And if you translate that, it was, you need to lose your house, you need to lose your job. We need the economy to cool down. We need you to stop buying stuff, right? We need you to be in a tough economic situation, which unfortunately is what they're doing. So, look, when it comes to the Piper, Sandler, and the Sam rule, what you need to understand is that neither of these things, again, are perfect. Even the lady who made the SAM rule, check this out, even she came out and said there's a good chance that this one could actually be a false positive. Now, every time this indicator's flashed in the past has basically been an indication that the economy is already in a recession. One time, I think it flashed and the recession came 5 months later. So pretty accurate in saying, hey, recession's here, except maybe this time. And even she says, maybe this time it's wrong, which is interesting. And she said a few different things why it could be wrong, that Texas employment data wasn't properly factored in due to a hurricane that had come through and other stuff like that. It's worth keeping in mind, too, when we have this sort of conversation around unemployment numbers. It's about the trends, right? Why the markets freaked out so bad last week regarding US unemployment numbers was not because of the total percentage, but because of the trend that it keeps moving up. The unemployment does. So people keep losing their jobs. That's very, very problematic because often when you see a 4.5% to 5% unemployment rate, that's when things start going wrong. Things start breaking. There's too much chaos in the economy. But there's that reality. And then there's also the reality of huge amounts of immigration that have been happening to the United States, both illegal and illegal. So that's propping up the jobs market. That's keeping the economy trucking along. And also that's very interesting, by the way, is that the total number of jobs now, there's about 6 million more employed people in the United States than there was before COVID. So within 4 years, the US has added 6 million total jobs, but the total unemployment rate's gone up a little bit. I know you're probably listening to all this stuff and thinking, man, why do I have to worry about unemployment rates? Unfortunately, the reality with crypto is that it highly responds to risk on, risk off attitudes in the market. And if the market decides to go risk off in a big way because of US recession fears, then pretty soon you'll know all about why it was worth paying attention to.
All right, let's go to the yield curve. Lots of talk around the yield curve and it flipping, turning positive on fears of recession. Explain to us what's going on here.
So yield curves, basically what happens is when the yield curve inverts, it means that the 2-year bonds are giving higher returns than the 10-year bonds or long-term bonds, which generally shouldn't be the case. You should be getting more money for locking up your money for longer with long-term bonds. Makes sense, right? Short term should pay lower amounts of money. So it's a sign of dysfunction in the bond markets, and the bond markets are big, right? And so that inversion happened back in 2022. When that happened, as you will probably remember, things started falling apart, and it was kind of a symptom of all the other economic chaos. Now, currently, we are on the verge of uninversion. So, where the 10-year bonds will be paying a higher rate of return than the 2-year bonds. So, the yield curve uninverts. By some measures, it's already uninverted. By the Fed's own measure, it hasn't quite, but it's on the verge of uninverting. Now, here's the worrying part. The yield curve has basically been a very strong recession indicator with a near perfect hit rate for the past century almost. And that uninversion is when things start to go wrong. So the question is this time going to be different? Remember, Sir John Templeton told us that those are the 4 most dangerous words in investing. So it's worth paying attention to because every time this yield curve has uninverted for almost the last 100 years, a recession has followed shortly thereafter, often within 2 to 6 months. So that kind of gives us that potential for Q4 rally around the elections, and then, things could really go down fast if based on the yield curve, right?
Right. And we're going to get to a little bit later in this conversation, even though we're 3 for 3 on things that are signaling recession coming, does not mean that all of this is accurate. Want to go through 2 more indicators that are not looking good right now. Let's talk about manufacturing numbers in the US.
Yeah, so manufacturing numbers is another one of those canary in the coal mine things, but look, it can be a deceptive number too. You see how much fluctuation there can be month on month and stuff like that. But the worry is that it's been going down recently. And so people are saying, well, manufacturing is going down. That must mean less consumer demand, but consumers are still spending strong. So the US economy, in spite of all of these indicators that might tell you otherwise, the US economy keeps stubbornly being strong and people keep spending money and all this stuff. But a fall in manufacturing is problematic for a variety of reasons. This is the Philadelphia Manufacturing Index. And so this essentially shows that businesses are doing less business. And if they do less business, they need less employees, which means more people get fired from the jobs, which means unemployment goes up. And companies are paying less in taxes and people have less money and all this kind of stuff. Now, part of that problem for the manufacturing industry in the USA is that rates have been so high for so long that it's hard for companies to borrow money to expand and to invest in new equipment and stuff like that as well. Consumers, of course, are getting hit. We could throw the housing market in here too. That's kind of the fifth thing we want to talk about here. But I think it's good to mention around this time because essentially when you have the housing markets in such a state of chaos right now where the prices are down big time on people's houses, so there's no wealth effect anymore. When house prices are up, people have the wealth effect. They borrow against their houses. They use it to make speculative investments or buy new boats or buy things that companies manufacture in Philadelphia, right? Stuff like this. But that's not happening right now because house prices are lower, right? Everything's gone down 15, 20% more in some cities in the USA. Plus, people are having a really hard time selling houses right now. So this dysfunction in the housing market has massive impact because it's one of the biggest asset classes. Well, real estate is the biggest asset class in the world, but certainly one of the biggest in the United States when we talk about investment opportunities and stuff like that. So it has a big effect, and it's one of those symptoms of massive dysfunction in the markets.
Okay, so some bad, some not so good looking stuff, but it's not all bad. And this is where it
No,
gets confusing. Is
it's very
it's
confusing.
not like every indicator is saying it's bad. There are actually quite a few positive indicators right now that say that we're not headed towards a recession. So keep on listening, because if you're not already trying to figure out what's going on here, you're going to learn that it's not easy to figure all this out. So let's talk about what are some of the good things that are happening in the US right now.
Yeah, I know listening to all this, by the way, you just kind of feel like,
Yeah.
like, what's going on? But there are good things. That's what makes the current situation so difficult, and why so many are saying that a lot of this could just be false signaling. And that if the Fed, there's a narrowing window for the Fed to actually pull off whatever they are trying to pull off without causing complete devastation. But if the Fed can still pull that off, that there's still a chance that this other stuff doesn't matter. So, for example, the GDP growth in Q2, 2.8%. That's crazy. Now, look, I'm not an economist here, but I'm pretty sure when your economy is growing at 2.8%, that's not a recession, right? Because a recession is classified as when your economy is in negative growth territory. So the US economy, despite everything we've just talked about, has stayed resilient. The problem is, how much longer can it stay resilient for? That's what's got everybody freaked out right now, because if Jerome Powell doesn't cut hard and fast enough, bad outcomes are likely to happen in the markets. And that GDP growth will slow real fast. Just because we had a good Q2 doesn't mean Q3 is going to be great. So far, it's probably going to be okay. But for how long? So hopefully, these GDP growth numbers are showing us that we are still doing okay and that this other stuff's potentially more noise than signal.
Okay, another number that everybody will be watching this week in particular is CPI, the inflation rate in the US.
So right now, the expectation, and by the time you guys watch this, you might already have those inflation numbers out. Expected is 3%. So that's the expectation right now. So it's currently at 3%. So the expectation from the market is that there's not going to be a change in inflation, which in of itself can be a bit worrying and might make the Fed hesitate on those rate cuts. Now, right now, the market is basically factoring in an almost certainty of a rate cut in September by the Fed. The only question is whether it's going to be 25, 50, or 75 basis points. But 3% inflation is not bad. Okay. We've had a huge downtrend in inflation. Things have generally gone pretty good. There's been some moments when we spike back up a little bit, but you look at the prices of like corn and soybeans and all that stuff, down massively. There are some small worrying signs that inflation could have potential to start tracking back up. For example, the cost of shipping containers out of China has increased dramatically in the last 2 or 3 months. So that could be a problem, because that obviously China makes everything. That then carries down to the end consumer, because if companies in the USA have to pay more to get their stuff shipped, guess who's paying the costs? Not them, it's you, right? So that could have an inflationary impact, pushing this back up potentially, which you don't want to see, because if inflation starts going back up, hold on to your butts. It's going to get nasty, in my opinion. A slight bump, not a problem. Big bump, not good. Now, this week in particular, the expectation is 3%. If it comes in at expectation, markets probably are going to be fine. If it comes in at 2.9%, markets are probably going to quite like that. If it comes in at 3.1%, again, hold on to your butts because markets probably are not going to like that. And it's going to cause even more fear and panic in an already fragile market.
Any other indicators that are signaling good for all of us out here that are worrying?
Yeah, I know. You're probably thinking, hey, wait a second, Lark. Wasn't the inflation supposed to be a good one? The inflation's good if it keeps going down, right? And it has been down a lot. It's down from 9.3% or something like that in 2023 down to 3% now. So this is largely saying to the Fed that the job's been getting done. There's other things too that are positive, like rail traffic in the USA is up 15% or something like that in the last quarter. And that means that there's more economic activity happening, that companies are doing stuff, companies are ordering stuff, business is happening, right? And that's a good thing. That's a positive thing. It's hard to ignore those kind of things. So there are, again, we have such a mixed picture right now. If everything was just signaling bad, then you can say, well, recession's definitely coming. If everything was signaling good, then great, recession's not coming. But we have some very strong indicators saying warning sign and other indicators saying maybe not worry that much. Another one too we could talk about really is just the impact of rate cuts and what that's actually going to mean. Because here's the deal. Historically, if you have rate cuts that happen outside of a recession, it's good for markets. If you have rate cuts that happen inside of a recession, bad for markets. Usually rate cuts inside of a recession, you'll see markets still go down quite a bit from that point of rate cuts. Currently, there's no recession in the USA by the majority of metrics. I know we have all these signals, the yield curve, the SAM rule, whatever, saying recession's coming, but it's not here yet. And if the rate cuts come in September, as the market generally expects that they will, then we get rate cuts outside of a recession, which historically have seen markets pump at least for some time. Again, looking at that Q4 rally. So that's, I think, what a lot of people are banking on right now. So the rate cuts are going to be very, very important. The Fed has been too high for too long, I think, at this point. And we need it, or things are probably going to go real bad real fast.
Okay, so we got some bad, but we got some good. Quite honestly, we got a kind of a mix of confusing information in terms of figuring out where this is going. So if we step back from this all, what do you think the likelihood of a recession actually is?
Hold on a second. It's got a coin here. Let's have a look. Heads recession, tails no recession. Let's go. Okay, we're gonna do that again. Hold on a second. No. Look. So look. It was heads. Okay, no recession. We're gonna be fine. Look, but no, seriously, guys. Nobody really knows. This is one thing you have to understand about markets is that everybody's got intelligent, clever models, right? But nobody knows for certain. Recessions do always come. They are a part of the business cycle. You need to expect them and anticipate them because they're always going to come. The question we want to ask ourselves right now is, does that recession come soon, by the end of the year? Or is it going to be 2026 or something like that? There's this old thing. I don't know if you've ever seen it. It's the Benner model. This guy back in the late 1800s, early 1900s, he was like a pig farmer or something. And he basically charted out 100 plus years of market movements based on what he saw as cyclical movements in the price of pork. Very interesting. What's very interesting is the scary accuracy of that over time. You should go look it up. It's very interesting. And that's currently saying, if you're curious about what a pig farmer from 100 years ago had to say, that's currently saying that 2026 is going to be the year of economic Armageddon. So we shall see. We shall see, right? Look, right now, the big banks are giving 1 in 3 odds. So JP Morgan's sitting here. They're looking at the yield curve inverting, and they're going, you know what? Best I can do is 1 in 3 odds. Right? Think about that. Think about that. Now, I know JP Morgan, Goldman Sachs, they're agents of chaos. You can't necessarily trust anything that they say. Still, though, if the big banks are sitting here and looking at it and going 1 in 3 odds of recession by the end of the year, I mean, those are betting odds, right? So 2 and 3 odds that it's not going to be a recession by the end of the year. And by the end of the year, it could be December, right? So it doesn't mean, again, that there can't be a big rally between now and that officially happening. I think their rate for 2025 is they give it a 45% chance of recession in 2025. But the flip side is you have to remember They can be wrong. JP Morgan back in 2022 was like recessions, like 100% guaranteed, and then it didn't happen. I mean, technically, there was a recession in 2022. We had 2 quarters of negative growth in 2022 for the USA, but we don't count it like that anymore, okay? It's only when the government tells you the recession. Don't believe your lying eyes. And that's another thing you can look at and say, well, a recession technically already happened in 2022, and this is just post-recession recovery, and all this other stuff is just lagging indicators. So it's an interesting one. Now, how to navigate all this stuff? This is probably one of the most important things for investors to keep in mind, because, okay, nobody really knows what's coming. Nobody knows if a recession is going to happen, but what do you do? Right?
You're asking my question for me, Lark. Thank you.
I know. You're welcome. I know. But it's an important thing to think about, because the reality of markets is that recessions always happen. The only question is when they happen. And are you prepared for them when they do happen? So there's a couple big things you need to keep in mind. One, you need to take profits mercilessly, especially if we get a great Q4. Everyone's going to be bullish. Everyone's going to be super euphoric. And all this stuff hasn't gone away. So perhaps you want to take a little more off the table just to be safe, right? One thing that people tend to forget in markets is that you can always come back in later too. You don't have to walk away forever. I feel like when you talk about selling anything in crypto, it's like you violated some sacred rule and you're going to be banished forever. You can be flexible with your portfolio. These are wildly speculative assets. They will not fare well in a recession. Best case, Bitcoin's going to go down 60%, Ethereum down 70%, and all those dog coins you think are the new paradigm money right now are going to go down 99.99999%. They'll reach new depths that you didn't even know were possible. You're going to, it's down 99%. It can't go down another 99%. Oh no, it can go down 99% and then go down 99% again and again. You'll have fun. It'll be a great time. So cash positions, get cash. When the market starts pumping again, think about your cash position. How can you build a strong cash position for the worst possible market outcomes? You don't have to go out of the market. I have no plan of going all out of the market. But my personal thought is, if we get a nice Q4 rally, which there's a lot lining up to say that we could get a nice Q4 rally, if that happens, taking a lot more money off the table, getting a cash position aside, make sure your taxes and stuff are taken care of. Okay, guys, that's going to catch a lot of people out. You don't want to have to be forced to sell your crypto in the bear market to pay your taxes. Okay, so make sure you're taking out the cash for your taxes. Make sure you're taking out enough cash to be able to ride any difficulties in market conditions. What if you lose your job, right? A lot of people don't even think about this. What if you lose your job? Recession hits, you lose your job. But if you've got cash, I'm telling you, you're gonna thank yourself for taking profits off the table when you have them. So, and of course, if you do have cash, then you have flexibility. If you're all in all the time, you don't have the flexibility to be able to buy during the recession, because the reality is that when the recession comes, whether that's 2026, whether that's Q4 this year, again, nobody really knows. But when that comes, if you have cash on hand, then you're going to be able to take advantage of that opportunity.
Lark, thank you so much for joining us and giving us the lowdown on the likelihood of a recession. And I hope that our listeners are not panicking or fear as a result of this type, because that is when you make emotional decisions, which we all know is a bad idea as an investor. But also have a plan. And that's really what this episode is all about, is helping you plan for both sides. We're not always going to be the bulls here. There is always going to be the good, the bad, and the ugly of being an investor in this space. Remember, as always, that none of this is financial advice. Investing in crypto and any asset is risky, and you should only invest what you can afford to lose. If you enjoyed today's episode, please give us a like, give Lark over a follow on his Twitter, hook him up as well, smash the like button, subscribe so you stay up to date, because you know Lark is with us every week, and we're going to be talking about this again in future weeks as to where we are, because these indicators change and move constantly, and we want to make sure that you are up to date. If you are afraid and you want a community, make sure you join our community. We'll make sure you're okay through all of this. Thanks so much for listening, and everybody have a wicked awesome day.